Before we talk about Raymond Realty as a stock, let's talk about something much more important. Every successful investment starts with understanding the business, not the share price. Imagine two friends open two shops in the same city. One shop earns a profit of 10 lakh rupees every year, has loyal customers, keeps expanding, and owns valuable land in a prime location. The other shop earns the same profit today, but struggles to attract customers, borrows heavily, and has no clear growth plan. If both shops are put up for sale at the same price, which one would you buy? Most people would choose the first shop because they are buying a business, not just today's profit. The stock market works exactly the same way. When you buy a share of a company, you are becoming a tiny owner of that business. The price on the screen changes every day, but the true value of the company depends on how well that business performs over many years. That is why, before looking at charts, targets, or predictions, we need to understand what Raymond Realty actually does. Raymond Realty is not just another real estate company. It is a relatively new independent company that emerged after being separated from the well-known Raymond Group. Think of it like a talented athlete who has always played as part of a team but is now competing individually. As an independent company, its own performance, decisions, and execution become much more visible to investors. This separation is important because investors can now evaluate Raymond Realty purely as a real estate developer rather than as one division inside a diversified business. That often brings greater transparency, allows management to focus entirely on one industry, and makes it easier to compare the company with listed real estate peers. Now, what exactly does Raymond Realty build? The company develops residential projects, primarily in the Mumbai metropolitan region. These include premium apartments, luxury homes, and large integrated townships. Some of its projects are located in high-demand areas such as Thane, Bandra, Mahim, Wadala, Sion, and Kandivali, locations where land is scarce and demand has historically remained strong. To understand why this matters, imagine two fruit sellers. One has a stall in a quiet lane with little foot traffic. The other has a shop in the busiest part of the city. Even if both sell the same quality fruit, the second seller usually has an advantage simply because of location. Real estate follows a similar principle. A good location doesn't guarantee success, but it often gives a developer better pricing power, stronger demand, and a higher chance of selling homes quickly. One of Raymond Realty's biggest strengths is that it owns and develops projects in locations where land has become increasingly difficult to acquire. In addition, the company has access to a significant land bank with the potential to support many future developments. A land bank simply means land that the company owns today but plans to develop over time. You can think of it as a farmer owning fertile fields that have not yet been cultivated. Those fields represent future opportunities rather than immediate income. According to the company's disclosures, this land bank provides visibility for several years of future projects. But owning land alone is not enough. A company must convert that land into homes, sell those homes, collect money from buyers, complete construction, and finally recognize revenue and profit. Every step has to work smoothly. This brings us to one of the most important ideas in real estate investing. Many beginners believe that if a company announces a large project, it immediately becomes profitable. That is not how the business works. Suppose a developer launches a housing project worth 1,000 crore rupees. Customers may start booking apartments today by paying an initial amount. Construction may continue for 3 or 4 years. Revenue and profit are recognized gradually as construction progresses and regulatory conditions are met. This means there can be a long gap between announcing a project and actually earning money from it. This is why investors pay close attention to something called pre-sales. Pre-sales refer to the value of apartments or homes that customers have booked before the project is fully completed. Think of it like a restaurant accepting reservations weeks before opening. The reservations show demand even though the meals have not yet been served. Raymond Realty reported strong pre-sales growth, indicating that customers are showing interest in its projects. Strong bookings suggest that buyers are willing to commit their money, which improves confidence about future revenue. However, bookings alone are not enough. Those bookings must eventually translate into customer payments and completed projects. That leads us to another important term, collections. Collections simply mean the actual money received from customers. Imagine you own a furniture business. You receive orders worth 10 lakh rupees, but customers have paid only 2 lakh rupees so far. Your order book looks impressive, but your bank account tells a different story. Businesses survive on cash, not promises. Raymond Realty has reported healthy customer collections, but investors are also watching whether collections continue to keep pace with growing bookings in future quarters. A slowdown in collections can eventually put pressure on cash flows, even if demand remains healthy. Now let's look at another interesting aspect of the business. Instead of buying every piece of land outright, Raymond Realty has increasingly adopted what is known as the Joint Development Agreement or JDA model. Imagine you own a valuable piece of land but do not have the money or expertise to build a large residential complex. A developer approaches you and offers a partnership. You contribute the land. The developer contributes the design, construction, approvals, marketing, and execution. Once apartments are sold, both parties share the benefits according to an agreed formula. This arrangement allows developers to expand without spending huge amounts on land purchases. It reduces the amount of money locked into land and can improve the efficiency with which capital is used. Raymond Realty has signed several JDA projects, making this an important part of its growth strategy. However, every advantage has another side. Partnerships also require coordination. Delays in approvals, disagreements with landowners, or execution issues can affect project timelines. So while JDAs reduce upfront investment, they also introduce another layer of operational complexity. Another positive factor is the company's brand. The Raymond name has been associated with trust and quality in India for decades. Although clothing and real estate are different businesses, an established brand can still help create confidence among homebuyers, especially in premium housing, where purchasing decisions involve large sums of money and long-term commitment. A trusted name may help customers feel more comfortable buying a home that will be delivered several years later. The company also operates through multiple housing brands catering to different customer segments, from premium housing to luxury developments. This broadens its addressable market instead of depending on just one category of buyers. Infrastructure development is another factor working in its favor. When new metro lines, expressways, coastal roads, or major transport projects improve connectivity, nearby residential areas often become more attractive to buyers. Better connectivity reduces travel time, increases convenience, and can support property values over the long term. Several of Raymond Realty's project locations stand to benefit from ongoing infrastructure development in the Mumbai region. But before we get carried away by these positives, it is important to remember something. A good business story does not automatically make a good investment. A company may have excellent locations, a respected brand, strong demand, and an exciting future pipeline, yet still disappoint investors if it struggles with cash flows, debt, execution, or valuation. That is why experienced investors never stop after understanding the business. They ask a second set of questions. Is the company actually making money? Are profits growing consistently? Can those profits be sustained? Is the business generating cash or only accounting profits? How much debt is it carrying? Are large investors buying or selling? And perhaps the most important question of all, is the current share price already reflecting all these positives? Or is the market still missing something? These questions take us from understanding the story to understanding the numbers. Because in the stock market, stories may attract attention, but numbers ultimately decide whether a company earns investors' trust. The numbers behind the story, understanding whether Raymond Realty is truly creating wealth. Now that we understand what Raymond Realty does, let's answer the question every investor eventually faces. Is this a good business? Or is it simply a good story? Stories create excitement. Numbers reveal reality. Imagine two restaurants. Both are crowded every evening. From the outside, they look equally successful. But after looking at their accounts, you discover that one restaurant earns a healthy profit every month, while the other barely breaks even because its costs are too high. Which restaurant would you rather own? The answer is obvious. The same principle applies to companies listed on the stock market. This is where financial statements become our window into the business. They tell us whether management is actually creating value or merely creating headlines. Let's begin with one of the simplest and most important numbers. Revenue, the company's sales. Revenue is simply the total value of goods or services sold. Think of a grocery store. If customers buy groceries worth 1 crore rupees during a month, the store's revenue is 1 crore rupees. It doesn't matter whether the owner made a profit or not. Revenue only tells us how much business came through the door. For Raymond Realty, revenue has grown dramatically over recent quarters. Sales have increased from a few hundred crores to well over 1,100 crore rupees in the latest quarter, while annual revenue has expanded sharply as more projects reached stages where revenue could be recognized. This is important because growing revenue usually indicates one of three things. More homes are being sold. Larger projects are being completed. The company is expanding its business. In Raymond Realty's case, all three factors have contributed to the growth story. But revenue alone doesn't make investors rich. Imagine selling smartphones for 50,000 rupees each. If every phone costs you 52,000 rupees to manufacture, selling more phones actually makes you poorer. That's why we need to look at profits. Profit, what the company actually keeps. Profit is the money left after paying expenses. Suppose you sell a house for 1 crore rupees. After paying for land, construction, labor, cement, steel, approvals, salaries and taxes, if 15 lakh rupees remains, that is your profit. Raymond Realty's profit growth has been extraordinary. Its quarterly profits have increased multiple times over, while annual profits have expanded significantly after the demerger and strong project execution. This tells us something encouraging. The company isn't increasing sales by sacrificing profitability. Instead, profits have been growing even faster than revenue. That usually attracts investors because it suggests the business is becoming more efficient. However, there's another question. Is every rupee of additional revenue creating proportionately higher profits? That brings us to operating margins. Operating margin, how efficient is the business? Imagine two builders constructing identical apartment buildings. Builder spends 95 rupee to earn 100 rupees. Builder B spends only 80 rupee to earn 100 rupees. Which builder would you rather own? Obviously Builder B. The difference lies in efficiency. Operating margin tells us how much money remains after paying the regular costs of running the business. If a company has an operating margin of 20%, it means that for every 100 rupees earned from customers, 20 rupee remains after paying normal operating expenses. Raymond Realty's operating margin has improved significantly, reaching around 20% in the latest period, the strongest level reported so far. This improvement matters because it suggests the company is earning more from every project without costs rising at the same pace. Why can margins improve? Several reasons. Projects may command better prices. Construction may become more efficient. Premium housing may contribute a larger share. Economies of scale may reduce costs. Better execution may reduce waste. But investors should also remember something important. One outstanding quarter doesn't automatically establish a long-term trend. Margins can fluctuate depending on project mix, construction costs, commodity prices, and accounting recognition. Therefore, investors should watch whether Raymond Realty can consistently maintain margins near current levels over the coming years. Earnings growth, Why everyone is talking about Raymond Realty. One reason Raymond Realty has attracted attention is the sheer pace of earnings growth. Its revenue and profit growth numbers have been exceptionally strong compared with many listed peers. But here we must slow down. Rapid growth sounds exciting, yet experienced investors always ask another question. What is the base? Imagine two students. One improves from 10 marks to 30 marks. Another improves from 90 marks to 95 marks. The first student's marks increased by 200%. The second student's marks increased by only 5%. Yet the second student still scored much higher. Similarly, companies showing spectacular percentage growth may sometimes be growing from a very small starting point. Raymond Realty's recent growth has benefited from factors such as the demerger, project execution, and a relatively lower comparison base in earlier periods. That doesn't make the growth less impressive. But investors should recognize that such extraordinary percentages are unlikely to continue forever. As companies become larger, maintaining triple-digit growth becomes increasingly difficult. Return on equity. Is management using shareholders' money well? Suppose you invest 100 rupees in a small business. After 1 year, the business earns 20 rupees. Another business also receives 100 rupee but earns only 5 rupees. Which owner used investors' money more effectively? The first one. Return on equity, commonly called ROE, measures exactly this. It tells us how efficiently management uses shareholders' capital. Raymond Realty reported an ROE of approximately 36%, which is exceptionally strong for the sector. Generally speaking, anything above 20% is considered healthy in many industries. 36% indicates the company is generating substantial profits relative to shareholders' investment. High ROE often reflects good management, efficient operations, or strong pricing power. However, one caution is necessary. Sometimes ROE appears high because a company uses large amounts of debt. So we must also examine another measure. Return on capital employed. Imagine two farmers. One owns farmland worth 1 crore rupees and earns 10 lakh rupees. Another owns farmland worth 1 crore rupees but has also borrowed 1 crore rupees from the bank and earns 20 lakh rupees. Which farmer uses all available resources more effectively? To answer this, we need a measure that considers both shareholder money and borrowed money. That's exactly what return on capital employed, or ROCE, does. Raymond Realty's ROCE is close to 30%, placing it among the stronger performers in the listed real estate space. A high ROCE usually indicates efficient use of total capital. Together, strong ROE and ROCE suggest the business is currently converting invested capital into profits very effectively. Valuation. Why does Raymond Realty look cheap? Now we reach one of the most discussed topics. Valuation. Imagine two houses. Both are nearly identical. Same size, same neighborhood, same quality. One sells for 2 crore rupees. The other sells for 1 crore rupees. Naturally, buyers begin asking why. The stock market works in a similar way. The most common valuation measure is the price-to-earnings ratio, or PE ratio. Think of it as asking, how many years of current profits am I paying for? If a company trades at a PE of 15, investors are paying 15 rupees for every 1 rupee of annual earnings. Raymond Realty trades at around 15 times earnings, while many established real estate peers trade at significantly higher valuations. At first glance, this makes Raymond Realty appear inexpensive. Some investors see this as an opportunity. Others see it as a warning. Who is correct? The answer depends on why the valuation is lower. Sometimes a company is undervalued because the market hasn't recognized its potential. Other times it is cheaper because investors see risks that are not immediately obvious. Understanding that difference is one of the hardest parts of investing. Why has the market not fully re-rated the company? If Raymond Realty has strong earnings growth, strong return ratios, premium locations, a respected brand, and relatively low valuation, Why hasn't the market valued it like some larger peers? Because the market is looking beyond today's profits. Investors are asking difficult questions. Can this growth continue? Can projects be executed without delays? Will customer collections remain strong? Will cash flows improve? Will institutional investors return? Will margins remain healthy? These unanswered questions partly explain why the stock still trades below many established competitors despite impressive financial performance. Looking beyond the headlines, financial statements tell us what has happened. They don't guarantee what will happen next. Think of driving a car. The rearview mirror helps you understand where you've been. The windshield helps you see where you're going. A wise driver uses both. Similarly, investors should appreciate Raymond Realty's impressive financial progress while also recognizing that the future depends on execution, cash generation, and disciplined growth. The numbers tell us this company has built a strong foundation. But foundations alone don't complete a building. The structure still has to rise. And that's where the next and perhaps most important part of the story begins. Because despite all these impressive financial metrics, there are several concerns that prevent Raymond Realty from being considered a completely risk-free investment. Some of those concerns are hidden deep inside the cash flow statement. Others relate to debt, institutional ownership, execution risks, and the very nature of the real estate business itself. Understanding those risks is just as important as appreciating the company's strengths. Because great investors don't ask only what can go right. They also ask, what could go wrong? And is the potential reward worth taking that risk? If you've stayed with me until this point, you've probably realized that Raymond Realty is neither a company that should be blindly celebrated nor one that should be dismissed because of a few concerns. It sits in an interesting position. On one side, it has many characteristics that investors actively search for. On the other side, it has several unanswered questions that prevent the market from giving it the same valuation as some of its larger competitors. The investment journey often resembles planting a mango tree. On the day you plant the sapling, you don't see any fruit. For the first few years, all you notice are expenses. You buy the plant. You water it. You add fertilizer. You protect it from storms. If someone judged the tree only by the money spent during those years, they would conclude it was a terrible investment. But someone who understands the full cycle knows that today's investment creates tomorrow's harvest. Real estate companies often operate in a similar way. Money is invested today. Projects take years to complete. Revenue is recognized gradually. Cash flows fluctuate. Only after several years do the full benefits become visible. The challenge for investors is identifying whether the tree they're watering is healthy, or whether it was never going to bear fruit in the first place. This is exactly where Raymond Realty stands today. The company has already demonstrated several encouraging signs. Its revenue has expanded sharply. Profitability has improved. Return on equity and return on capital employed are among the strongest in the listed real estate sector. Operating margins have reached their highest levels so far. The company has built a sizable development pipeline supported by a valuable land bank, premium locations, multiple housing brands, and an increasingly asset-light joint development agreement strategy. If these trends continue to reinforce each other, Raymond Realty could gradually evolve from being viewed as a newly listed developer into one of the more established names in India's premium residential real estate market. But successful investing is never about assuming the best outcome. It is about continuously checking whether reality is matching the original investment thesis. Imagine you're flying on a long international flight. The pilot doesn't simply take off and relax for the next 8 hours. Every few minutes, instruments are checked. Weather conditions are reviewed. Fuel consumption is monitored. The route is adjusted whenever necessary. Investing requires exactly the same discipline. Buying a stock is not the end of the process. It is the beginning of continuous observation. So what should investors monitor in Raymond Realty over the next few quarters? The first and perhaps most important indicator is operating cash flow. Revenue and profit have already impressed the market. Now investors want proof that those accounting profits are turning into real cash entering the company's bank account. If operating cash flow gradually moves toward positive territory while profits remain strong, one of the biggest concerns surrounding the company would begin to reduce significantly. The second indicator is customer collections. Think back to the restaurant example. Reservations are encouraging. Meals served are better. Payments received are best. Similarly, bookings generate excitement. Collections build confidence. Consistently improving collections indicate that customers are fulfilling their financial commitments and projects are progressing as expected. The third area to watch is project execution. Raymond Realty has announced a substantial pipeline across multiple projects. Announcements create expectations. Completed projects create credibility. Investors should therefore monitor whether construction progresses according to schedule, whether projects receive regulatory approvals on time, and whether customers continue taking possession without significant delays. Execution has always separated exceptional developers from average ones. The fourth indicator is operating margins. Current margins are healthy, but maintaining them is often more difficult than achieving them once. Construction costs can rise. Steel prices fluctuate. Cement becomes expensive. Labor shortages may occur. Competitive pricing pressure may increase. If Raymond Realty can sustain healthy margins while continuing to grow revenue, it would suggest that the business possesses pricing power rather than simply benefiting from temporary factors. Another important area is debt. Borrowing itself isn't the problem. The question is whether borrowed money generates higher future returns. If debt increases while projects remain delayed and cash flow stays weak, investors naturally become cautious. However, if borrowing supports profitable expansion that generates stronger cash flows later, debt becomes a useful tool rather than a burden. This distinction is extremely important. One should never ask only, how much debt does the company have? A better question is, what is the company achieving with that debt? Institutional ownership deserves attention as well. Earlier we discussed foreign institutional investors and domestic institutional investors. Their reduced ownership after listing has been one of the concerns noted by investors. This doesn't automatically mean the company lacks quality. Large institutions may reduce exposure for reasons completely unrelated to the underlying business. Portfolio rebalancing, liquidity requirements, allocation limits, sector rotation, global market conditions, all can influence institutional buying and selling. However, if Raymond Realty continues delivering strong financial performance while institutional ownership eventually begins increasing again, it would indicate growing confidence among large professional investors. Another important factor is promoter confidence. Management has increased its ownership after listing, which generally sends a positive signal because promoters are committing more of their own capital to the business. Still, investors should continue monitoring promoter pledging. A declining pledged percentage would strengthen confidence even further. One area that deserves special attention is the joint development agreement strategy. Instead of purchasing every parcel of land, Raymond Realty increasingly partners with landowners. This approach reduces the amount of capital locked into land acquisition and allows faster expansion with potentially higher returns on capital. However, partnerships require smooth coordination. Approvals, legal agreements, construction timelines, revenue sharing. Any disruption can affect project execution. Therefore, investors should evaluate not only how many JDA projects are announced, but also how efficiently those projects move from announcement to completion. The broader real estate environment should never be ignored either. Housing demand depends on many factors beyond a company's control. Interest rates, employment, household income, consumer confidence, government policies, infrastructure development, mortgage affordability. Even an outstanding developer cannot completely escape these economic forces. Fortunately, Raymond Realty currently operates in premium markets that continue to benefit from strong demand and ongoing infrastructure development in the Mumbai metropolitan region. Yet market conditions can always change. This is why long-term investing requires patience rather than certainty. Now let's step back and ask one final question. If Raymond Realty were a student, how would we evaluate it? Academically, it has scored exceptionally well. Revenue growth, profit growth, return ratios, operating margins, business pipeline, brand recognition, land bank, expansion strategy. All of these resemble high marks in different subjects. But the report card also contains teachers' remarks. Needs improvement in cash flow. Monitor debt carefully. Watch execution. Observe institutional participation. Ensure growth remains sustainable. In other words, Raymond Realty is not a perfect student. It is a high-performing student who still has a few important areas that require improvement. And that may actually explain why the market values it differently from some older developers. Markets rarely reward only today's performance. They reward confidence that today's performance can continue tomorrow. Can Raymond Realty become a long-term wealth creator? The answer is neither an automatic yes nor an automatic no. If management continues delivering strong earnings, improves cash generation, maintains financial discipline, executes projects efficiently, and converts its large development pipeline into completed homes, the company could gradually narrow its valuation gap with established peers. If, however, cash flow remains persistently weak, execution slows, debt rises without corresponding returns, or demand weakens meaningfully, the market may continue assigning a valuation discount despite strong accounting profits. Ultimately, investing is not about predicting the future with absolute certainty. No investor, analyst, or television expert can consistently forecast every outcome. Instead, successful investing is about making decisions based on probabilities rather than promises. Raymond Realty currently presents an interesting combination of growth, value, and execution potential, balanced against meaningful but understandable business risks. That combination makes it neither a guaranteed winner nor a company to ignore. It makes it a business that deserves careful observation. Because the greatest opportunities in the stock market often emerge not when a company has already become perfect, but when it is steadily proving that it is moving in the right direction, while the market is still deciding whether to fully believe the story. Perhaps the most valuable lesson from Raymond Realty isn't whether someone should buy or sell the stock today. The real lesson is how to evaluate any business. Don't be impressed only by rapid revenue growth. Don't celebrate profits without checking cash flow. Don't fear debt without understanding its purpose. Don't assume a low valuation always means a bargain. Don't assume a high valuation always means quality. Look at the complete picture. Understand how the business earns money. Study whether management allocates capital wisely. Observe whether customers continue trusting the company. Watch whether execution matches promises. And remember that every investment is a balance between opportunity and risk. When you begin asking these questions, not just for Raymond Realty, but for every company you study, you stop thinking like someone chasing stock prices and start thinking like someone evaluating businesses. And that shift in thinking is often what separates long-term wealth creation from short-term speculation.
Don't forget to like and subscribe.